Holy flippity flip flop flap and smokes, everyone. Things have just got so much worse. We are in big trouble. The economy is crashing. Mass layoffs are happening, companies' earnings are crashing, and a yield curve which has predicted every single recession, that's the difference between the 2-year US Treasury yield and the 10-year US Treasury yield, has just hit its steepest inversion in 41 years. People, it's time to wake up right now because we are in a recession, even though the government doesn't want to admit it, and now we're starting to see the early signs that this is going to be a great recession or depression. And ladies and gentlemen, we have just got huge new news today about what's happening with Target, about what's happening with company earnings, again, the yield curve, and also the Federal Reserve coming out there and saying they're not going to be there to save the day this time. So everyone, let's not waste any time. Let's get straight into the news, the facts, and the data. Okay, everyone, this is a huge story right now. Target warns a weak holiday quarter and plans to cut costs as profits tumble and sales slow. This is huge, everyone. Normally, this is a time of year where retailers see a huge spending boom, but it's looking like this holiday spending season is going to be one of the weakest in years. Consumer is getting destroyed by record inflation. They've taken on a record amount of debt, which I'll get into in a moment, and they just simply don't have the discretionary spending to spend on items that they don't need. It's all going on gas, utilities, rent, etc. They just don't have any money left over anymore. And this is what we've been warning about on the channel, everyone. We've been saying that Q3 earnings are going to be weak. Some companies have done okay, but majority have done pretty bad. But Q4 is only going to get much worse because the Federal Reserve has lifted interest rates so fast, we haven't got the data yet to see how that's affecting the economy yet. We're starting to see early signs, but remember, interest rates aren't even close to the peak yet. They still got at least another 1.5% to go. So I think 2023 is going to be a very painful year for these retailers. Look at this, Target is cutting its fourth quarter outlook after seeing sales slow in late October. The big box retail saw sales decline as families contend with higher prices, making trade-offs between what they need and what they want. And it plans to cut up to $3 billion in total costs over the next 3 years. So again, like I said, Q4 is going to be very bad. Families don't have the discretionary spending anymore, and they're going to be doing massive cuts next year, $3 billion in cuts. And remember, someone's spending is another person's income. So they're cutting these costs. Well, that's going to flow on to other companies and it's going to have a contagion effect, and they're going to have to announce more layoffs as well. Like what we're seeing with Amazon announcing layoffs, Twitter, huge amounts of tech companies announcing layoffs. We're seeing real estate firms announcing layoffs, mortgage companies announcing layoffs. We're seeing the auto sector announcing layoffs. This is going to lead to the unemployment rate skyrocketing. And I think the Federal Reserve will pivot eventually, maybe mid next year, but there is no pivot coming anytime soon. And look at this chart, everyone. When this news came out, Target's share price absolutely collapsed, crashing 16% after this earnings report. And if you think Target's going to be the only stock crashing during this retail apocalypse, you're going to have to think again. We're going to see more and more companies crash after their earnings report, just like what we saw with Amazon and many other companies, because we just got more alarming news that the consumer is in big trouble. Look at this, household debt soars at fastest pace in 15 years, a credit card usage surges, a Fed report says. This is a recipe for disaster, everyone. Interest rates absolutely skyrocketing right now. Interest payments on these credit cards are over 20%. I've even seen some cases they're paying 25 to 30% for consumers that have bad credit scores. And these people that are getting caught up in this credit card debt is a huge trap. There's simply no way they can actually pay it back once they fall behind, at least maybe 1 year behind payments. The interest payments and the interest costs just continue to skyrocket and they fall more and more behind. Look at this, household increased debt at its fastest pace in 15 years due to hefty increases in credit card usage and mortgage balances. So that's another worrying trend here. Not only are people's credit card usage going up to record highs, but also people are taking equity out of their home and their mortgages are going to record highs as well. Again, this is a recipe for disaster, and unfortunately, it's going to end in tears. But what we're seeing is people are forced to take on debt to keep up with the rising cost of living. But unfortunately, people, what you're going to have to do if you're in a tough situation like this is you're going to have to really pull up your sleeves, try to find a way to start a side hustle online that costs absolutely nothing. Even though people are saying, well, there's a recession coming, you won't be able to make money. You can just make videos like I'm doing now. You can get paid to do what you're passionate about. But if you don't want to do that, try to find a way to start a part-time job to try to get this debt paid down and you're going to have to look at your expenses like you're a corporation, like you're looking at a balance sheet, and figure out, like what these companies are doing, ways you can cut your costs. And there's going to be tough times coming, people. There's just simply no easy solution around it. But for those people that do work hard, for those people that do anything they can, there is hope. There is a light at the end of the tunnel, and you will get through this. They say the increases stem from a combination of robust consumer demand and high prices, a Fed official says. So another thing that's coming out in this report and what we got yesterday was retail sales were up 1.3%. And they're saying, look, the consumer's still strong. They're still spending like crazy. No, what's really happening, everyone, is prices are going up. That's why retail spending is going up. It's just because things are getting more expensive, not people buying more things. And also what we may be seeing as well is people are buying things, or they're trying to get ahead of the inflation by buying things now because they know it'll be more expensive in the future. But I think once people's balance sheets keep getting reduced, once people's savings rates, which I'll get into in a moment, keep falling, they won't be able to do this anymore. Because look at this chart, everyone. This is the US personal savings rate. We can see it hit a peak in April 2020 of 33%. That was from all the stimulus checks. Then again in March 2021 of 26%, but it's just been declining lower and lower and lower, and has now hit a new recent low of 3.1%. So people only being able to save 3% of their income, and the trend is still going down. So it doesn't take an economist or a genius to figure out that if consumers are taking on record debt, their savings is getting wiped out, the cost of everything is going up, that we're going to see demand absolutely plummet in the fourth quarter. And what that means is when these companies' earnings come out, when they do this earnings report, like what Target did, we're going to see stocks absolutely get hammered. Now, also some alarming news, what happened in the markets today was the yield curve. This is what is predicted every single recession, or every time there's a recession, the yield has inverted before that happened. And this is something I've been trying to warn about, but it just hit its steepest inversion we've seen in over 41 years. Let's have a look at this. Okay, everyone, like I said, this is the difference between what interest investors get paid on a 2-year treasury and a 10-year US treasury. Now, you'd think that if you're going to lend money to the government over 10 years, you'd want to get a higher interest payment. But no, it's actually lower. Look at this. It inverted first in July, on July 5th, and now it has continued to plummet. People thought, okay, maybe the inversion isn't going to be so steep. Maybe it's going to be a recovery. Maybe we'll uninvert. But no, we've just hit a new low, and is now the difference is 0.57%. So what that's telling us is they think interest rates in the short term are going to go even higher than what many people or the Fed officials are saying, or many of the mainstream media analysts are saying. And people, we got data today that confirmed, yes, interest rates are going to go higher, and they're going to be higher for longer. Look at this. Fed's daily sees rates rising at least another percentage point as pausing is off the table. So again, everyone, you see what happens after every single Federal Reserve meeting, after every single inflation report. People say, well, now the Fed is going to pivot. This is when we've hit peak inflation. Which, remember, we've had inflation reports where it came out that the CPI was only 0% or 0.1% when Joe Biden said there was no inflation, and then the next report came out and he said it was only up by just an inch. But then we saw inflation surge higher from there, which is what I think could happen early next year. I expect that oil prices are going to go higher again once the US starts to refuel their strategic petroleum reserves. But the $1 trillion question we need to know the answer to is, how high will rates go? Remember, they said, we'll just lift interest rates 1% this year. Then they said 2%, 3%, 4%. And I was telling everyone, no, they're going to have to go to at least 5%. People thought I was crazy. They said there's no way they could do that. The US government will go bankrupt, which they could if it keeps on going this way and they don't do something. But remember, they can just get the Federal Reserve to monetize the debt and they'll just make inflation worse, the dollar crash. But all they're going to do is just try to kick the can down the road. But we are going to be facing severe economic consequences for what they're doing right now. Listen to this. San Francisco Fed President Daly told CNBC that our most recent estimates puts the benchmark overnight lending rate at 5%. So holy smokes, everyone, even the Federal Reserve is admitting that they're going to have to go to 5% now. And some people are even saying that they're going to have to go higher than this. So we've got also another report from Bloomberg. Goldman Sachs Group Inc. now expects the Fed to boost its key rate to a range of 5% to 5.2%, up from the previous call of 5.75% to 5%. Now, I'll let you in a little secret. These central bankers, they try to massage or ease the markets. They don't want to cause panic. So what they do is they leak these news, or they leak these Fed zombies speaking. They say, look, we're going to go to, say, 5%. And then the next month they'll say, oh, maybe we'll go 5.2%. And then the next month they'll say, oh, okay, 5.5%. See the pattern here, people. They keep on just slightly increasing it every month, not to cause panic. Because you know what would have happened if at the start of the year they said, look, we're going to have to lift interest rates to 5% to stop inflation. We would have saw the markets absolutely crash, and we would have seen a financial crisis like in 2020 when the money markets freeze up and the interest rates on the 10-year US Treasury absolutely spiking and spiraling out of control. But no, what they're trying to do is just try to tease the market. They go, okay, we'll just go a little higher and just a little higher. She sees a point where the Fed will be able to elevate the impact of hikes before moving higher, but that is not now. Pausing is off the table right now. It's not even part of the discussion. So remember when they were saying we're not even thinking about lifting interest rates? Well, now they're not even thinking about pausing at all. So despite what you hear on mainstream media saying that they're going to pivot, they're going to pause, people, it is not going to happen now. Now, I think they will eventually pivot and they will eventually pause, but I think we're not anywhere close to that. I think that's going to happen probably mid-2023 as we see the unemployment rate skyrocket as all of these layoffs get announced. But it takes time for us to get that data, and it takes time for this to play out. I think the unemployment rate next year will skyrocket, and eventually inflation will go down, but it's going to take time, and it's going to be a very, very slow process, and inflation just doesn't gradually go down. What happens is we see volatility will go down as prices go down a little bit lower, or it's not really prices going down, it's just the price increases are slowing down. Then all of a sudden we'll see spikes, and then we'll see it go down again. This is going to be a volatile ride, everyone. It's going to be a very bumpy ride, so you're going to definitely need to prepare right now. Again, my forecast hasn't changed. I don't think we've seen the bottom in the markets, even though we can see bear market rallies here, everyone. That is not reason to FOMO in. My plan all along has been wait for a 35% decline from peak to trough in the S&P 500. I'm patiently waiting. Things could take time. Things could take even years, possibly. But when the moment does come, unlike all these people that have been buying the dip and now they've got no money left to buy the real dip, while you have money on the sidelines to buy the real mega dip. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.